Yeah, thank you for having me, and indeed interesting question. So I think the big picture here is the following. We do have euro area growth this year muted because in the later part of the year, we get increasingly headwinds from monetary policy, while a supporting factor actually is decline in headline inflation, which it looks like from the data. I mean, we have to, of course, await tomorrow's print for the consolidated version of all that. But it looks like that we get a little bit more headline inflation than had been anticipated by both us and consensus, which should be at the margin better for consumption. So that actually is sort of constructive for the outlook. Now, at the same time, inflation is, as you know, this discussion is about headline and core. So core inflation, from what we see here in the prints, I mean, this is of course not yet fully reported, but I think there is an element here that is probably confirming that the peak is in March, or has been in March, which is actually has so far been a working hypothesis in the council, and that could potentially be confirmed as something that we can count on, which to us I think just confirms our view that we have another 25 basis point hikes in front of us, and then they can call it a day with the last hike in July, 375. As to your question, are the DAFs, if you want to call them like that, strengthened by that? I think in general, it's always good that we have some sort of landing zone ahead of us in terms of inflation, and that should sort of help the discussion in the council to find good ground for compromise. And as I said, 375 looks very good as a core, which of course is our core as well at this point.
It's interesting as you talk about two further rate hikes out of the ECB. At the same time, the ECB in its own financial stability report out this morning has warned, in particular in the housing market, about a potential disorderly fall in house prices and in the housing market as the impact of higher rates makes its way through markets and suppresses households' ability to finance homes and suppresses investor appetite for those homes. And how do you expect those further hikes to be absorbed?
Well, first of all, in some sense, this is just confirming what's already there in the curve. I mean, the ECB pricing is more or less there, what I just said, around 375. And I think your commentary before had said that we have essentially seen a decline in long rates, which I would argue is the most important part for house purchases or house purchase decisions, as you say. I mean, of course, we have to see that we are coming out of a long period of very low rates that to some extent have artificially inflated house prices. So part of the correction here is actually healthy. And I think where policymakers need to be watchful and have an eye on is whether there is something that goes beyond that healthy correction. And again, I mean, also as the ECB has been stressing, I think most prominently in the press conference in March, one side of it is control of inflation, and the other thing is financial stability. Two different tool sets or toolkits that will be deployed for each. The monitoring is, of course, an important part of the toolkit of the financial stability arm, say, and of course they have to make visible these risks, but I don't think that will change anything in the rate trajectory in particular because, as I said, it's already in the prices anyway.